Hey, welcome to another Mortgage Minute. My name is Jeff Harrison, along with your host and expert, Art Alvarez. Art, welcome. How are you today?
I'm doing good, Jeff. How are you?
Good. Hey, I think the last time we saw each other, you were heading out for vacation. How was it?
It was good, as vacations usually are, and mine was as well. So back and relaxed and ready to go.
Fantastic. Hey, before we get started, let's just take half a second and just tell people about the show, what it's designed to do, and then I know you've got a lot to cover today, so we'll get right into it.
Yes, Jeff. Yeah, the purpose of the show, we call it the Mortgage Minute. And of course, our tagline is that Mortgage Works, we have the answers and they're on the house. And so the intent with this broadcast is to basically give you some pertinent information about everything real estate and mortgage related, answers, if you will. And so that's what we try to do every week. And so I think I've got some pretty good information for everyone to listen to and to take a look at that I think will be helpful if they're looking to enter the real estate market, maybe buy a home or need to get a mortgage, whether it's a purchase or a refi. So it'll be some good information. I think everyone will get a benefit out of.
Fantastic. Well, let's jump right in. I know you've got some information as the markets are hot, so active. So let's just turn that over. I'll step aside and we'll turn it over. I'll bring up your slides for today.
Sure. Okay. Sounds good.
Oh, before I let you go, I just want to remind those people that are joining us today. This is a live program. I'll be watching in the chat for comments. If you have any questions concerning the topics today or any other questions, please put them in the comments and I'll get them over to Art and he will answer them.
Okay, well, with the Mortgage Minute, again, I mentioned we have a few things that we're going to be talking about. The first thing I wanted to cover is just to kind of give you an update about the financial markets and in particular what's going on with mortgage rates. And in that regard, there's a few things that are going on. And of course, there's this continuing issue. You see the headlines about is a recession coming or not? That's part of what I'm going to cover today because I happen to have a benefit of listening to a pretty good economic forecast this morning. So I'll touch on that in a little bit more detail. Some of the information in terms of economic statistics that have come out recently includes the CPI for March. Of course, CPI is Consumer Price Index. It was at 5.6%. Now, that's still elevated, but it's encouraging because it does show a sort of trend downward in the inflation numbers. So in that regard, we should be cautiously optimistic. The other recent economic statistic that came out was consumer spending, which actually declined about 1% over February. In other words, a 1% decline in March over February. So now both of those, the inflation still being somewhat high, a decline in consumer spending would seem to argue for the possibility that recession is still on its way. But I've got some information that I'll share with you here just momentarily that may suggest otherwise. Because of the fact that the CPI was a little bit better than expected, and with this decline in consumer spending, there's more talk in the financial markets that the Fed at their next meeting in May may either hold steady and not raise the Fed funds rate further, or if they do, they may only do that by another 0.25%. Now, remember, of course, now we're at an 8% prime rate, which of course is directly tied to the Fed funds rate. So whether that actually happens or not, don't know yet, but we'll know in early May. But I think the overall point there is that the Fed does seem to be slowing in terms of their efforts to keep raising the Fed funds rate to combat the inflation numbers. Now, in regard to, and I talk about this all the time, if you're not in the business already and you want to kind of just read the trends of where mortgage rates are going, the best thing to look at, as I'm always mentioning, 10-year Treasury bond yield. Right now, it's about 3.54%. Now, that's a little bit high from or elevated from the low we saw recently of 3.40%, but not by much, obviously, about 14 basis points. I think what's optimistic about that is it's a continuing sign that the 10-year yield and correspondingly mortgage rates seem to be stabilizing. We haven't seen mortgage rates continue to climb. They seem to be plateauing a little bit in this high 5, 6%, low 6 range. And I think we should take some encouragement out of that. So I think the worst is over in terms of rates continuing to climb. So you should keep that in mind if you're looking to get into the market to buy a home. And then the next point is I mentioned earlier, I happened to have the opportunity to see a presentation this morning, an economic forecast for both California as well as here locally in the Coachella Valley. And it was presented by Dr. Christopher Thornburg. He's a PhD in economics. He's the founder of Beacon Economics. And he made an interesting declaration. He essentially declared that a recession is highly unlikely in the next. And saying that, he pointed out a few things that I think would be helpful for all of you to be aware of. And one point he made was that inflation and higher mortgage rates are due to excessive stimulus, which of course occurred during the pandemic when the Fed pumped a whole bunch of money into the money supply because of the pandemic. But beyond that, Dr. Thornburg pointed out there's really no major structural imbalances in the economy currently. And in other words, the economy is actually doing pretty well. And you may be surprised to hear that, given some of the news that you hear or see with the media. Consumer and business investment, he argues, will offset the current weakness that is in place with real estate and finance because of these higher mortgage rates. So in his mind, that helps support the idea that the economy actually is pretty strong, not necessarily in any likely way going to head into a recession. And then he did point out that home prices will deflate, but they will deflate slightly and slowly. But fundamentally, the housing markets will remain sound. And of course, think of it this way. As we've talked about, most homeowners out there have very low mortgage rates, and they have now quite a bit of equity. Now, that's different than the Great Recession of 2008. So that bodes well that even if we do see some home prices deflating by, say, 5 to 10%, that still has the homeowner with a good amount of equity remaining. That's going to avoid any kind of situation with, homes hitting the market due to foreclosure and so forth. So in that regard, a little bit of a decline in values, but if you're expecting a big decline, I would argue don't think that way. So again, if you're looking to buy a home soon, you shouldn't wait for lower prices. I think you should get into the game now. And then one of the biggest issues that Dr. Thornburg pointed out, and he said this a few times during the presentation, was beware the narrative. His point being that in the media, both written, on social media, the local, newscasts, et cetera, lots and lots and lots of negative news about the economy. When, of course, what he did in this presentation was point out all these stats that suggested completely the opposite. The economy is actually fundamentally pretty sound, which is, again, why he's predicting that there will not be a recession over the next couple of years. So his kind of parting recommendation was there's going to be an ongoing gap between the narrative and reality. And so beware that narrative and try to focus on the reality. And if you do, then you're going to find that things are actually a lot better than the media would lead you to believe. So given all this, mortgage rates, again, are still hovering in the conforming loans in the high 5s, 6% range. Government loans like FHA, VA are still in the mid 5s. So all in all, that's pretty good. And so as a consequence, don't be too worried about rates going forward and getting a lot worse. I don't think you're going to see that happen. So on my next subject I want to talk about is a new product that's called Home Safe Second Mortgage. Now, we're doing a lot of equity loans now, both fixed rate seconds and in particular, a lot of HELOCs. But there's another market that's now going to be served with this product, and it's for the senior homeowner. Now, we do run into situations where there'll be a senior homeowner who has tons and tons of equity. They'd like to tap into that. So, of course, the common presentation is to talk about a reverse mortgage. Well, a lot of these homeowners may have a relatively small first mortgage on their home. They're handling it fine. They're making the payments comfortably. And on more than one occasion, I've had a homeowner say, I don't really want to touch my existing first mortgage. I'm not having trouble making that payment, but I have all this equity. I'd like to tap into it. What can I do? Well, this Home Safe Second Mortgage is for that purpose. It's an alternative for a senior homeowner who does not want that reverse mortgage if it's going to pay off their existing first. So what does this entail? What's interesting about it is it's not your traditional fixed rate second mortgage where you have a term of, say, 10 to 30 years. With this product, what's unique about it is there's no fixed term. So it is a junior mortgage lien on your property, but it doesn't have a term where, it's got to be paid off within 10 or 15 or 20 or 30 years. So that's pretty unique as, secondary financing goes. Another feature of it is you don't make payments. Again, that's similar to a, reverse mortgage where you're not making payments. And with the Home Safe Second Mortgage, the same thing. When you get this loan, no payments are required. And then the next unique feature of it, this is not necessarily unique, but the rate on this product is actually pretty good when you consider it the second mortgage. This is a fixed rate product with rates as low as 8.99%. When you consider the prime rates at 8%, and a lot of HELOCs now are at 9.5, 10%, this is actually a very good rate for a second mortgage. And should be attractive to senior homeowners who, again, are looking for a way to tap into that equity without getting the reverse mortgage. The other feature about it is what loan amounts are available. You can get this loan with loan amounts from $50,000 up to $4 million. So for those senior homeowners who have are fortunate enough to own a very high value property, and where they may have equity to the tune of maybe 7 digits in the millions, and again may still have a relatively small first mortgage, and they want to tap into that equity, this product, believe it or not, will go all the way up to $4 million in loan amount. So that's pretty attractive, pretty unique. And then the next thing is you do have to have a minimum credit score. Now that's a little bit different than a reverse mortgage. A reverse mortgage doesn't have a minimum credit score per se. This program does require that you have to have at least a 600 credit score to be eligible to have access to the program. And if your credit score is 640 or higher, then the assessment, your financial assessment that you go through, is more streamlined, and it's a little bit easier to get the loan. And then the last thing about it is, and this is very important, this is a non-recourse loan, just like a reverse mortgage. And as a reminder, what does non-recourse loan mean? Well, what that means is that, in the future, when the senior homeowner vacates the property and the loan has to be paid off, the senior homeowner or their family, if the senior homeowner has passed away, they are not required to cover any deficiency balance in the loan amount should the value of the property, if it had fallen at the time the senior homeowner has exited the property. So that if the family ends up having to sell the home, and if what's owed on that home between the first mortgage that was already existing plus this Home Safe Second, if those two combined exceeds the value of the home when it's sold, then the family that inherited the property will not be responsible for the deficiency balance. So it's a very important feature of this product and should be a reassuring feature for that senior homeowner. So again, it's a new program, great alternative for that senior homeowner who wants to tap their equity, but they don't want the reverse mortgage. So I just think that's very good for you to be aware of. So anyone out there that is a senior homeowner that would like to look at this option, this is something we'd be happy to talk to them about. Now, the next item that I wanted to cover, and this is kind of interesting, I want to go over a little bit closing costs because there's a little bit of a disconnect between the perception of closing costs and, again, the reality. And I had a recent example of this where I arranged a purchase money loan for a borrower. Loan amount was about $460,000. And when they first got the worksheet from me, they looked at it, and of course, the way the worksheet's designed, it suggested that the closing costs were going to be a little bit over $10,000. And they reacted a little bit negatively to that. And I said, well, hold on, let me clarify for you really what that is telling you. And what I pointed out is that there's two types of costs related to getting a mortgage when you're purchasing a home. Now, one is what we call non-recurring costs. And what I like to say is that these are the costs that are truly the fees or the charges that you're going to incur when you get the loan. What that means is these are going to be coming from third parties who are going to actually charge a fee for a service performed. Excuse me. Now, the most obvious example of that would be the appraiser, the credit report company who's providing the credit report. But it can be other things like all the escrow and title fees, the escrow fee, the endorsement fee from the title company, the sub-escrow fee, the notary fee. These all generally are coming from the escrow or title company handling your transaction. Excuse me again. Now, the other section or subset of closing costs is what we call recurring or prepaid closing costs. Now, this includes what are not really fees per se, but things related to the property in mostly, other than the fact that there will be prepaid interest, which is just a proration from when the loan funds and where you have to pay the interest till the end of that month because your first mortgage payment's another month after that. But then the other funds that have to be provided is homeowners insurance. You have to buy a 12-month, you have to pay a 12-month premium when you close the loan. And then there's property taxes. Those are prorated. And in the case of homeowners insurance and property taxes, if you are going to set up what we call an escrow account or an impound account so that the lender's paying those for you on your behalf, then you have to provide advance funds to set up those accounts. Now, again, that's not a fee being charged to you by a third party. And then the last item is HOA dues. If you have HOA dues, you may have to pay those. You usually have to pay 1 month in advance, and there may be a transfer fee from the HOA company. And as a result, in many cases, if not most cases, the prepaid costs can be equal to or higher than the non-recurring third-party fee-based charges. For example, I still have the worksheet from that recent transaction I did. And for them, the non-recurring closing costs were $4,300. But the recurring or prepaid costs were $5,700. My point to this home buyer was, even if you didn't get a loan, most of the recurring costs, other than the prepaid interest, because you're not getting a loan, would still be there. So that's an important distinction to make. So as a consequence, just realize that when you're getting a purchase money loan in particular, and you're getting an impound account for your taxes and insurance, it's quite possible that the actual fees being charged to you are going to be less than half of the total closing cost amount. So that's important to know, so that in that regard, you'll realize that maybe you're not really being charged too much. And some of these costs are going to be something you would incur even if you were paying cash for the property. So it's an important distinction, one that I think you should keep in mind. Excuse me. Now, the last item I want to talk about, it's another product. It's a preferred jumbo loan program. Now, this program is pretty unique, which I'm going to say why here in just a second. But keep in mind, it's called preferred for a reason. It's for very well qualified borrowers. So not everyone is going to have access to this if they don't meet some pretty specific loan qualification requirements. Now, that's not to say the qualification requirements are unreasonable, but again, this is for your very well qualified borrowers. So if you're a little bit challenged on credit score, your debt ratio is a little bit on the high side, this may not be a product you'll have access to. And in fact, this program does have an additional step in terms of being able to get it, which is program access. So what we have to do when I encounter a home buyer who's looking to use this program, the first thing we have to do is get an application, gather up some basic information. We have to submit this to the lender and get approval just to have access to the program. So that's an additional step, unlike most other mortgage programs. So that's the first step. We have to determine, will you be granted access to the loan program that this entails? And if you are, then you're going to go through the normal underwriting process where we're going to have to submit a full package and have your application fully reviewed and approved. Now, here's the primary feature that for this program that is really, really unique and I think very compelling for anyone who needs a jumbo loan. And that is for loans on second or vacation homes, which is a pretty common, pretty popular program. Very popular purchase option that a lot of homeowners are looking for to buy, a second home in a resort area. They're going to use it part of their time, and then the part of the time they're going to rent it out, typically with short-term rental. What's unique about this program is the rates offered on this are the same as a primary home. Now, you might say, well, wasn't that always the case? Well, yes, it was, but no more. The old story, that was then, this is now. What do I mean by that? Well, about a year ago, in fact, I think it was a year ago this month, the FHFA, the Federal Housing Finance Agency, increased the price adjustment factors. That's a technical term, but the bottom line is the cost of a loan on a second home in terms of rate was significantly increased by this action taken by this agency. Now, this agency, by the way, the Federal Housing Finance Agency, they oversee the two GSEs, government-sponsored enterprises, which is Fannie Mae and Freddie Mac. So now, and I've had many, prospective home buyers over the last year get shocked when they're inquiring with me about getting a worksheet for a purchase of a vacation home in, let's say, the local, Big Bear area, or, down at the beach, what have you. When they see the rates, and they're shocked, and they're thinking the rate's going to be comparable to a primary home. Well, because of these changes by the FHFA a year ago, now loans on second homes are actually going to feature rates similar to a rental property, no longer your primary home type of a rate. And that differential can be substantial. So what's so unique about this program is whether it's primary home or a second home, and even with these jumbo loan amounts, the rate is the same. I mean, we can actually, and we are originating these with rates, starting at about 6% for a jumbo loan up to $4 million. As you can see there, the loan amounts actually do go up to $4 million. In fact, we can do a loan amount on a second home up to $1 million with only 20% down. And again, featuring the same rate as you would get if you were getting a primary home financed. So it's a great program. Access is limited. You have to be a very well qualified borrower. But if you're contemplating at all getting a second home and you're looking for a way to finance it at the lowest rate possible, keep us in mind. This is a great opportunity to access this program, and I'd be happy to help you, get that done. So with that, Jeff, those are the items that I wanted to talk about today. So I'll turn it back to you to see if we have any questions.
Art, your comments were very clear, and no, we don't have any questions. Just want to leave some information up there for folks that how to get more information from you that say, some of these things may play into my future. And so you can get a hold of Art at 760-883-5700, or you can go to the website at mwloan.com, or email art at mwloan.com. And you can certainly reach out and get more information there. So Art, one of the things I really liked about what you had to say there was that this whole narrative to the reality, and there's a gap in there. Let's face it, you have boots on the ground. Are you seeing more reality in the fact that, hey, it doesn't look like we're really going into a recession? Do you kind of align with that story that your gentleman shared with you?
I do, because and some of the other charts and graphs that he put up on the screen during his presentation just supported that. I mean, it was interesting to see that consumer spending, again, despite the March drop, is actually pretty darn strong. Believe it or not, restaurants, they're experiencing activity, if you call it that, 40% above what it was prior to the pandemic, 40% higher. So people are still going out and, buying those dinners and paying the money, despite all of us complaining about how expensive it's getting to buy a meal at a restaurant. Of course, and here locally in the Coachella Valley, in terms of hotel occupancy and transit tax and so forth, it's back to normal and beyond. It's actually there's a lot of signs that despite all the moaning and groaning, and in particular, despite all of those negative headlines that you see everywhere and every day, in reality, People are out there, they're spending money. And he even pointed out with the higher gas prices. Sure, we're all unhappy about it. We'd prefer to pay those lower amounts, but does that mean that people are staying home and not, taking their big pickup truck and towing their boat to the lake on the weekend? No, they're still doing that. And there's a lot of evidence of that. So all those are signs that despite what the media is saying, despite all the headlines, his argument was the economy is fundamentally sound. We still have to work through this inflation level and the higher mortgage rates. And again, as we've talked about before on this show, mortgage rates are higher, sure, but historically, they're not, way out of bounds. I mean, we've been at this level before. We do need to see some adjustment in prices in the homes, but those adjustments are not going to be substantial. So I think people need to realize is that these current conditions are probably going to be with us for a while. And to the extent you want some relief, say in buying a house and getting that mortgage payment lower, remember those tools that we can use: permanent rate buy downs, temporary rate buy downs. Those are the way to get into the home buying process now. And if we don't go into recession, that can only mean that even now, if you buy a home at these price levels, you're probably going to experience some pretty good appreciation and building your equity over the next few years. So I think overall, we should be more optimistic than a lot of us are walking around, exhibiting, because things are really better than we think. So.
Yeah, I have to agree with you. It's like, especially right here in the Coachella Valley right now. I mean, if you're in the Coachella Valley, it's the festival period
Right.
of the desert. And I was just reading this morning that we're expecting about 250,000 people between last week and this week to visit the Coachella. And so it just means besides those people, all the other people who come to the desert, because let's face it, it's gorgeous outside and a lot of things to do. It hasn't slowed down. It hasn't
No,
slowed down at all.
no,
I haven't seen any drop in any activity, and it's good to see. I think it goes back to the old days in the '60s. It said, if it isn't bleeding, it's not leading. So we're going to have
right.
to try to make up a bad narrative just to see if we can sell some news.
True.
And if we can get past those headlines and look into the information like you shared, we're like, wait a second, that's kind of a breath of fresh air. It's going to
Yeah.
be okay.
Yeah. Yeah. It was actually a very optimistic presentation this morning. I think everybody was a little bit surprised because I think they were thinking the opposite,
Uh,
but it just didn't happen. And he was armed with so many statistics and numbers that you couldn't argue with it. I mean, he's like, oh, yeah, he's right. So
I
I think
love it.
we all left that presentation feeling pretty confident about the future. So,
It's fantastic.
yeah.
Well, Art, I just want to thank you again for doing this. It's
Sure.
you've committed to do it every week on
Yep.
Thursdays at 2 p.m. from 2 to 2:30,
Yep.
and to answer questions live as they come in. Also, if you're watching this and it's recorded and you have a question, just put it in the comments. We monitor those throughout the week, and Art will be able to see those and answer those for you. And if you can join us live, fantastic. Share it with someone out there who may be thinking about buying a home, maybe doing refinancing. I like that whole idea of the second, what do you call it? The
Home safe second.
home safe second. Wow. That's, I think people watching this and they're thinking, well, I have, let's face it, we have been blessed with a lot of equity build up in our homes. And that was something, that you mentioned that was very sobering in a very positive way, because it's like, this is nothing like 2008 when the market went down, 20, 30% correction and we were all underwater
Yeah.
and we had no equity. Now, if it goes down, like you said, 5 or 10% correction, we're still in pretty good shape. We've got
Yeah.
a lot of equity.
Yep. Exactly.
So
There's enough equity there that the homeowner can afford a little bit of a dip in their home value and still not be financially endangered. So.
yeah, I like that. Well, if any of those things work out for you, those of you watching and sharing this, get a hold of Art. Art, I'm going to put up. Also, I did not show your cell phone. Is it all right if we put your cell phone up
Yes,
there?
please do. Of course, that's the way most people get a hold of me these days.
So that's Art at 714-612-9035. That's the red hotline button. So Art will answer that directly, and he'll get you taken care of. Art, thank you so much. I really appreciate it.
Thank you, Jeff, and thank you, everyone. And we'll be back next week with another Mortgage Minute. And just remember, at Mortgage Works, we have the answers, and they're on the house.
Fantastic. Thank you. Bye-bye.